Hey everyone, and welcome to India Explained. So, let's talk about something we've all wondered about. You've saved up some cash, now what? Do you go for an FD, an RD, or maybe a mutual fund SIP? It can feel a bit overwhelming, right? Well, today we're going to break it all down, super simple, and figure out what's the absolute best choice for you.
But hey, before we dive in, if you find this explainer useful, it would mean a lot if you could just quickly hit that like button, maybe share it with a friend who's also figuring this stuff out, and of course, don't forget to subscribe to India Explained so you don't miss out on more simple guides like this one. Okay, let's get real. Imagine this. You've done the hard work, you've been disciplined, and you've managed to save 5,000 rupees this month. Seriously, that's awesome. But then comes the big question. Now what? Where do you put that money so it actually starts working for you? Do you play it safe, or do you go for something with a bit more punch? That's exactly what we're going to figure out.
All right, so instead of thinking about these as, boring financial products with confusing names, let's picture them as 3 different guides for your money. Yeah, each one has its own personality, its own way of doing things. Let's get to know them, one by one.
First up, we have the fixed deposit, or FD. We're going to call this one the Safe Guardian. And honestly, the name says it all. The deal is super simple. You give the bank a chunk of money, you lock it in for a set amount of time, and they promise you a fixed interest rate. No surprises. It's predictable, it's reliable, and hey, your money is insured up to 5 lakh rupees by the DICGC. You really can't get much safer than this. So, what does that safety look like in real money? Let's take a look. Say you've got 3 lakh rupees to invest. You put it in an FD for 5 years at a 7% interest rate. At the end of that period, you're looking at a total of around 4,20,000. The big thing to remember here, that growth is steady, and you know exactly what you're going to get. No guesswork. Okay, next up is the recurring deposit, or RD. And this is the disciplined coach. See, unlike an FD where you need a big lump sum right at the start, the RD is all about building that saving muscle. It's perfect for getting into the habit. You just put in a fixed amount every single month, like clockwork. It's got the same safety as an FD, but it's really designed to train you, to get you into that consistent saving groove.
So let's bring it back to that 5,000 rupees we were talking about. What if you put that into an RD every single month for 5 years? Well, at about a 6.5% interest rate, you'd end up with a cool 3,55,000 rupees. It's amazing, right? It just shows you how those small, regular savings can really stack up into something big.
And finally, let's meet our third guide, the mutual fund SIP. We call this one the wealth creator. Now, with a SIP, that stands for Systematic Investment Plan, that same 5,000 rupees a month gets invested directly into the stock market through a mutual fund. And before you panic about picking stocks, don't. A professional fund manager handles all the tough decisions for you. But this path is a bit of an adventure. It's tied to the ups and downs of the market. Okay, so this is where things get really interesting. Let's take that same 5 grand a month for the same 5 years. Now, if we assume an average market return of about 10%, that could grow to around 3,90,000 rupees. But, and I've got to say this really clearly, this is an estimate. It is not a guarantee. The final number could be more, it could be less. It all depends on how the market does. All right, we've met our 3 guides, the Safe Guardian, the Disciplined Coach, and the Wealth Creator. So now, it's time for the ultimate face-off. Let's put them head-to-head and see how they stack up on the things that really matter. Okay, this chart here lays it all out, side by side. Let's walk through it. First, returns. See how FDs and RDs are fixed? Predictable. You know what you're getting. SIPs, on the other hand, are market-linked, which means they have the potential for much higher returns. Now that's directly connected to risk, right? FDs and RDs are super low risk. SIPs have market risk. The market goes up, you do well. It goes down, so does your investment. Then there's liquidity. That's just a fancy word for how fast you can get your hands on your cash. With SIPs, it's usually just a few days. Breaking an FD can be a bit slower. And finally, taxes. The interest from FDs and RDs gets added to your income and taxed. SIP gains are taxed as capital gains, which can sometimes work out better for you. It all comes down to that classic trade-off, safety versus the chance for bigger growth.
So if you boil it all down, this is the core choice you have to make. Do you want low risk and a guaranteed return, somewhere in that 6 to 8% range within FD or RD? Or are you willing to take on some market risk for the chance to earn much higher returns? Historically, over the long term, we're talking about returns in the 12 to 15% range with SIPs. It's all about that risk versus reward.
But hold on a second. I know what you're probably thinking, but an FD is totally risk-free, right? And that's a really good question.
See, while your money is safe from the stock market roller coaster, there's a hidden risk, a silent enemy called inflation. Just think about it. Let's say your FD gives you 6% interest, but that same year, the price of everything, your groceries, petrol, everything, also went up by 6%. So yeah, your money grew, but your power to buy stuff with it stayed exactly the same. You basically just broke even. The whole point of investing, especially with something like an SIP, is to beat inflation, to make your money grow faster than prices are rising.
Okay, so we've compared them, we've looked at the risks and rewards, so which path is the right one for you? Well, here's the secret. There is no single best option. The right answer completely depends on what you are saving for. It's all about matching the tool to your goal.
It really all boils down to your timeline. Let's make this super simple. If you have a short-term goal, something less than 3 years away, like buying a new bike or a phone, you absolutely cannot risk losing that money. So, safety first. An FD or an RD is your best bet. For a midterm goal, say 3 to 5 years out, like a down payment on a car, you could maybe consider a mix, maybe an RD with some less risky SIPs. But for those really big, long-term goals, anything more than 5 years away, think retirement, your kids' education, that's where an equity SIP really shines. That's what it's built for, long-term wealth creation.
All right, let's wrap this up with the most important stuff. If you take away just one thing from all this, here's what it should be.
So, to put it all in a nutshell, FDs and RDs are all about safety. They're your go-to for guaranteed returns and short-term goals. SIPs, they're for the long haul. They're about creating wealth, but you have to be okay with some market risk. The right choice for you? It comes down to your goal, your timeline, and how much risk you're comfortable with. And you know what? The really smart move is often not to pick just one. A balanced mix of both can be a fantastic strategy.
So there you have it, the Safe Guardian, the Disciplined Coach, and the Wealth Creator. We've laid it all out. They each have their own purpose, their own strengths. Now the only question that's left is the one that matters most. Now that you know the difference, what's your next money move going to be?
I really hope this helped clear things up for you. If you're looking for more simple finance explainers just like this, please make sure you're subscribed to India Explained. Thanks so much for watching, and I'll catch you in the next one.